Following the legal actions and settlement that the SEC has brought against Kraken, the exchange is effectively banned from offering staking services for the time being. The bad side of this action, banning crypto innovation, is only a myopic approach that will only manage to stifle innovation, crumple US competitiveness, and propel investors to seek potentially riskier options. It is quite baffling to hear that the Cardano founder, Charles Hoskinson, is emphasizing Cardano's immunity to this particular development. The crypto space has long remained a war zone between the US authorities, including the Securities and Exchange Commission and the Commodity Futures Trading Commission, due to the lack of definitive regulatory ownership and the illumination over whether crypto assets are securities, properties, or otherwise. As a result of all that has happened in the previous year with the collapse of the FTX exchange and lending platforms including Celsius, Voyager, BlockFi, and more, many believe that the SEC has more than enough reason to stand at the helm of affairs with matters connected to the crypto sector. Now, the SEC would focus on ensuring that the US-based crypto exchanges were aligned with local laws and fully solvent. Its actions might get even more intense. The crypto exchange Kraken has agreed to shut down its US cryptocurrency staking services and pay $30 million in penalties to settle the US Securities and Exchange Commission charges that it failed to register the program. But this was a move that could prompt distortions and cause headaches for the platforms with similar offerings. This settlement marks the SEC's first crackdown on staking, a common service offered at both centralized and decentralized crypto exchanges, including the prominent ones such as Coinbase and Binance. In a video message posted on Twitter, SEC Chair Gary Gensler noted that most staking providers fail to provide customers with proper disclosures, such as how a company is protecting a user's staked assets. He added that those providers ought to register their staking services with the SEC. Quote, "When a company or platform offers you these kinds of returns, whether they call their services lending, earn, rewards, APY, or staking, that relationship should come with the protections of the federal security laws." End quote. The crypto exchange Kraken offers its customers the power to stake certain crypto tokens to earn rewards. Its website advertises that users can earn up to 20% annual yield if they pledge to lock up their assets for a certain period. The platform did not admit or deny the allegations leveled against it by the SEC. In a statement, Kraken admitted that the agreement to end its on-chain staking services would only affect US clients and that most assets enrolled in the program by the US users would automatically be unstaked. Coinbase CEO Brian Armstrong said that he heard rumors that the SEC would like to ban retail investors from engaging in crypto staking, and in a series of tweets, he acknowledged that this action would be a terrible path for the US. Coinbase also offers a staking service to its US customers. While Armstrong's suspicions may come as a shock to many in the industry, Gensler has previously emphasized that cryptocurrencies that allow staking could be classified as securities as defined by the Howey test, although Ether has been designated as a commodity by the SEC's sister regulator, the Commodity Futures Trading Commission. After a congressional hearing in September 2022, Gensler told reporters that while he was not referring to any token in particular, staking was another indication that under the Howey test, the investing public is anticipating profits based on the efforts of others. Various reactions were channeled to this action by Alison Mandrio, the executive of the Proof of Stake Alliance, which told CoinDesk that her organization opposes any assertion that staking constitutes unregistered securities. Mandrio said, "Staking tends to get misconstrued with unrelated activities like lending, but staking is fundamentally a way for anyone to join, providing security for proof-of-stake networks." Charles Hoskinson, on the other hand, reacted negatively to Gary Gensler's speech regarding crypto regulation. Addressing the events surrounding the Kraken exchange, Gensler admitted that the commission is neutral towards cryptocurrencies and only aims to protect investors. So he was trying to imply that providers of various crypto services should simply abide by the rules, register, and comply. However, from Hoskinson's perspective, his words were lies, and there is no real possibility of registering or complying with the crypto service providers. According to him, one could spend millions of dollars a year and not get any answers or a viable way to do business in this area. In the same way, the founder and head of Kraken eventually reacted to Gary Gensler's call, but in a rather sarcastic manner. The entrepreneur stated that he was not aware that to avoid a fine of tens of millions of dollars and the closure of an entire business line, he had to fill out a form on the SEC website and warn users that staking awards came from staking. But let's get back to Charles Hoskinson's response to this development. Hoskinson addressed several concerns, including the impact of the settlement on Cardano and the fate of staking in the US in a live stream. He highlighted several key differences between staking program of his blockchain and the one offered by Kraken to reassure the Cardano community. The first point was that the token burn mechanism that the SEC described in its settlement with Kraken. He noted at the fact that his protocol has no token burning or slashing mechanism in place. In addition, he acknowledged that Cardano's staking payments were automated by the protocol, unlike Kraken's staking program. Going forward, Cardano had a minimum staking requirement, unlike Kraken, where no staking minimums were advertised. According to the SEC's complaint, Kraken's staking rewards were determined by the websites and not by underlying blockchain protocol. Charles Hoskinson pointed out that with Cardano, things are different. There are staking certificates in place, and protocol determines returns in a transparent and non-custodial manner. Charles Hoskinson pointed out another major difference, which was the custodial nature of Kraken's staking program, where interested investors transfer eligible crypto assets to the program. Plus, the staking program offered by Kraken set aside deposits for staking as a liquidity reserve. This essentially implies that the assets were locked. The highest returns for Cardano staking comes from private pools, in contrast with Kraken, where investors stand to make more in the form of regular rewards. In light of the ongoing contention regarding the security status of staking products offered by centralized and DeFi operators, Charles Hoskinson called out Cardano's rival blockchain, Ethereum. He tweeted, "Ethereum staking is problematic. Temporarily giving up your assets to someone else to have them get a return looks a lot like regulated products. Locking funds, encouraging centralization, and poor protocol design hurt the whole industry," Hoskinson added. All proof-of-stake protocols might get lumped together due to a fundamental misunderstanding about the facts of the operation and designs of staking. Similarly, Commissioner Hester Peirce, popularly known as Crypto Mom, shared her opinion about the SEC crackdown and tagging its actions as a not efficient or fair way of regulating an emerging industry. She said that the SEC again chose to speak through an enforcement action, opting to make clear to the marketplace that a staking as a service provider must register and provide full, fair, and truthful disclosure and investor protection. CryptoMom also noted that the SEC's action against Kraken enjoins it from ever offering a staking service in the United States, registered or not. The Cardano network has immensely benefited from staking. At the moment, according to staking rewards, Cardano ranks as the second largest proof-of-stake network after Ethereum, with a market cap of $9.22 billion. Ethereum has a staking market cap of $26.95 billion, but Cardano has a higher staking ratio of 72%, while Ethereum has one of 14%. And according to the pools.pm, 34 billion ADA have been staked across 3,182 pools. While this might sound huge, Cardano utilizes a unique staking mechanism that sets it apart from other proof-of-stake blockchains. According to ADA Well, Cardano's staking is crypto's biggest DeFi app, liquid, non-custodial, risk-free. In light of today's news, we should make a push for mass adoption. We don't need middlemen taking a cut. Get some ADA, download a wallet, pick a pool, click delegate, and be part of the revolution. Staking is one of Cardano's biggest flexes, and as long as the Cardano founder has assured the community of its safety and unrestricted growth, it's safe to keep one's hopes high. Charles Hoskinson has made it clear that the Cardano network, especially the aspect of staking, is built with distinct qualities that validate its immunity in this period of heightened regulation by the SEC. Banning should be a last resort and only after careful consideration in combination with sound regulatory guidance. It remains unclear whether bans will have any intended effect on protecting customers who wish to stake. However, in current circumstances, developers and users will adapt and find more convenient ways to continue staking their tokens, with or without the SEC. But of course, what are your thoughts on this? Let us know in the comments section below. We'll see you in the next video, but before then, check out other videos to find out how Cardano is living up to the dream of being the Ethereum killer. And as always, make sure you click on the subscribe and notification buttons.